Calm descends on European stock markets after an extremely volatile week, but with one of the most significant Fed meetings in years looming next week, it may not last. Out now to Michael Hewson, he's analyst at CMC Markets. Well, Michael, is it tin hats at the ready on Monday?
I don't know about tin hats at the ready. I don't think we're going to be taking them off, are we, Jamie? I think we've needed them this week with the volatility that we've seen. And I certainly think that's going to be a recurring theme throughout the summer. Absolutely right. We've seen a bit of a recovery in the Nikkei today, and we've seen a little bit of a stabilisation in European markets over the past 24 hours. But the fact remains, we're still going to probably close fourth week in succession lower.
Three words that you've used to me today to describe European stock markets and investor sentiment in general right now: childish, irrational and naive.
Yeah, pretty much.
Would you want to expand on that?
Yeah, I mean, obviously we saw this massive decline earlier in the week. I think it was driven by Asian markets, largely because investors were a little bit unhappy that the Bank of Japan didn't take additional stimulus measures to soothe the bond markets. But to be quite honest, you know, the Bank of Japan has to look after the Japanese economy, and Monday's GDP number out of Japan was quite a good one. 4.1% GDP year on year, revised up to 3.5. There's evidence that CPI inflation is starting to edge higher again, and the stimulus measures are really only 2 months old. So I think it's a little bit early to be expecting additional stimulus so soon after the initial kickoff. So I think there's certainly an element of irrationality going on. Having said that, we've had a massive rally, and now we're having a spot of profit taking.
Do we have more profit taking to come, whether it's in Japan and also here in Europe?
Well, I think that really depends on two key levels. On the Nikkei, that's 12,220. That's a 50% retracement of the entire up move from the lows that we saw in November. And the 6,200 level on the FTSE 100. The FTSE 100 in particular is very, very important because that level's held on at least 3 or 4 occasions since the middle of January. So I think if we break below that, then we could well see a significant sell-off. Likewise, the 12,200 level in the Nikkei. And I think the client sentiment aspect of that equation is also equally important.
But your clients are still, I imagine, largely long of both Japanese and European stocks.
They certainly are, but they're not as long as they were a couple of weeks ago. A couple of weeks ago, the Japanese Nikkei, they were 95% long, which suggested to me that we were well overdue a correction. Having said that, we've had a bit of a shakeout, still 77% long. Likewise, the FTSE 100, 61% long. And given our clients' positioning, that does seem to suggest to me that maybe we could see another test of the downside.
Okay, next week, as I said in the intro, it's all about the Fed and Bernanke. Going to be pretty choppy, one would imagine. What are you advising your clients to do? How do you trade what is bound to be a very uncertain time?
Well, while we hold above these key support levels, and I think let's bring the S&P into that. 1600, 1595, that's also a key support level on the S&P. If we hold above those key support levels, then I really think it's a question of buy the dip. But don't jump in. Wait for the market to come to you, because I don't think the Fed is going to produce too many surprises. I think the expectation that the Fed's somehow going to suddenly slam on the brakes is, again, naive. There's no question of them doing that. I think we're talking about tapering. Simply, it's sensible strategy to sort of, talk about your options, because QE has been going on since 2009, and that doesn't necessarily mean that we're going to be suddenly slamming on the brakes and exiting in the next 6 to 12 months.
Okay, Michael, thanks very much. Have a great weekend, and at least you've got 2 days to take off your tin hat. My thanks there to Michael Hewson. On now to our chart of the day, and shares in Hochtief, Germany's biggest construction company, are up almost 5.7%, the best showing in 5 weeks. Shares spiked after the builder said it would buy back as much as 160 million euros of its own shares. This comes barely 2 months after it agreed to sell its airports business for 1.1 billion euros. On to commodities. Basic resource stocks getting a lift after Citigroup raised its rating on the sector to overweight on valuation grounds. The Stocks Europe's 600 Basic Resources Index is up 1.2% today, outperforming the broader index, which is currently unchanged. And we have to leave it there, but do join us every weekday at 12 BST when we'll be taking the pulse of the markets. I'm Jamie McGeever. This is Reuters.